The hidden forces behind silver prices. Everyone asks the same question. Where is silver headed tomorrow? Will it skyrocket or collapse? Analysts throw numbers at you, charts, moving averages, Fibonacci retracements, RSI levels. They all look impressive. But what they rarely tell you is the truth about the forces that actually drive silver prices. It's not just supply and demand. It's not just inflation or geopolitical uncertainty. Those are the headlines meant to distract you. Behind the shiny silver coins and ETFs, there's a network of players who control timing, leverage, and sentiment with precision most investors can't even imagine. Central banks, bullion banks, hedge funds, they aren't guessing. They're orchestrating. And right now, they're preparing for moves that could make ordinary predictions meaningless. Take the case of quantitative easing. Every time a central bank announces it will inject liquidity into the financial system, a subtle chain reaction begins. Money flows first into the markets that influence silver indirectly: stocks, bonds, and even currencies. These moves shift the dynamics of safe haven demand. Silver doesn't just respond to economic fundamentals. It responds to capital flows engineered by those with privileged information and the ability to move billions at a time. Think about it. When rates rise, the dollar strengthens. Historically, that would pressure silver lower. But in reality, market operators can counteract this by buying futures, swapping contracts, or engaging in option strategies that mute the effect for months. You see the price move slightly, but the real positions are hidden. The retail investor sees a small fluctuation and thinks it's a signal. It isn't. It's a distraction. The question isn't whether silver will rise or fall tomorrow. The real question is, what are the networks of influence doing? And how long before their maneuvers trickle down to public markets? Because once you see how the system works, you realize something critical. Silver price predictions based solely on technical analysis or conventional economics are like trying to guess a chess grandmaster's next move by looking at the pawns alone. Bullion banks, hedge funds, and the orchestration of silver prices. Silver isn't traded in a vacuum. It's part of a carefully managed ecosystem, dominated by a handful of institutions that control the majority of futures, physical inventory, and global contracts. These players aren't speculating, they are strategizing. Bullion banks, the giants behind London's silver markets, hold positions so large that a single shift can move prices dramatically. They know when governments, central banks, and large investors will enter or exit the market. Every release of data, the inflation report, job numbers, or GDP growth, is analyzed, modeled, and anticipated. And then they act before you even see the charts react. Hedge funds amplify this effect. They are not just buying silver because they believe in its long-term value. They are leveraging information asymmetry, momentum, and market sentiment. Their algorithms trade against retail investors' emotions, front-running small trades and profiting from panic or exuberance. You might think the market is free, but these operators are playing a game where the rules are invisible to most participants. Look at the silver ETFs. On paper, they are supposed to track the price of physical silver. But in reality, ETFs are often hedged with derivatives, futures, and swaps. A surge in demand for silver coins or bars doesn't always reflect in ETF prices. The system is engineered so that institutional players can manipulate supply signals, creating an illusion of scarcity or abundance at strategic moments. And then there's timing. The strategic moves are often hidden in plain sight. Options expiration dates, reporting deadlines, and geopolitical events are all leveraged. Prices may appear stable, but in reality, positions are being shifted behind closed doors. When the public finally reacts, the market has already moved on. Ordinary investors end up chasing a trend that insiders created
or trapped into selling at the worst possible moment. This is why silver price predictions often fail. Analysts look at supply shortages, mine output, or industrial demand, but the invisible levers in the background are far more influential. When these levers move, the market obeys them, not any conventional logic. And here's the most unsettling truth. This orchestration is not illegal. It's embedded in the system. The rules allow institutions to dominate leverage, control large physical inventories, and execute high-frequency strategies without ever revealing their full hand. For the average investor, predicting silver tomorrow is not just difficult, it's almost meaningless unless you understand the machinery that drives every tick on the price chart.
Geopolitics, industrial demand, and silver's safe haven role. Silver has always had a dual identity. On one hand, it's an industrial metal, used in electronics, solar panels, and medical devices. On the other, it's a store of value, a hedge against uncertainty, a liquid refuge when markets falter. And that duality is exactly what makes it so manipulatable. Consider industrial demand. Reports come out showing rising consumption in electronics or solar energy. Analysts immediately predict higher silver prices. Yet for every ounce demanded by industry, another is strategically withheld or shifted in futures markets by bullion banks and hedge funds. The market reacts as if silver is scarce, even when inventories are sufficient. Prices spike, and the public sees only the headline, not the invisible orchestration behind it. Then there's geopolitics. Conflicts, trade tensions, sanctions, they all create anxiety. When uncertainty rises, investors flock to silver as a hedge. But the timing of these movements is not accidental. Large players often anticipate these events, positioning themselves to profit from the panic or the perceived safe haven rush. By the time the average investor notices, the market has already shifted dramatically. Silver's role as a hedge against inflation is another carefully managed narrative. Inflation reports are released monthly, yet bullion banks and major funds have already taken positions in advance. ETFs may show minor changes, futures contracts might appear stable, but behind the scenes, massive positions are hedged and leveraged in ways that ordinary traders cannot replicate. The public reacts to what they see. The insiders profit from what they already know. Psychology also plays a huge role. Silver has a storied reputation. It's tangible, finite, and universally recognized as money. Retail investors are emotionally drawn to it during times of fear. That emotional demand is predictable, and predictability is exploitable. Institutional operators can amplify the effect by creating artificial scarcity, tightening spreads, or releasing subtle market signals that trigger buying or selling frenzies. The market becomes a feedback loop. Fear drives price drives fear, and the insiders sit in the middle, collecting the profits. The lesson here is stark. Silver price predictions are not just about economics or industrial data. They're about understanding how human behavior is engineered to meet the strategies of those who hold the real power. And until you see the mechanisms, both visible and hidden, you're merely speculating, not predicting. Historical manipulations and patterns repeating today. Silver has always had a long history of being manipulated by those with power and foresight. The Hunt brothers in the 1970s tried to corner the market, driving prices from $6 to $50 an ounce in just a few years. Futures contracts, government interventions, and regulatory responses came crashing down, wiping out inexperienced investors while insiders protected themselves. Fast forward to the 2010s. During the post-2008 recovery, silver's price spiked above $48 per ounce, only to collapse when the bullion banks and large funds adjusted positions. Every major swing followed a familiar script: accumulation by insiders, speculative mania, engineered panic, and eventual consolidation at lower levels. The pattern is unmistakable. Each surge or collapse is not random. It's planned, timed, and amplified by institutional strategy. And if you understand this pattern, you can see the signals before the public reacts. Predicting tomorrow's silver price. Now let's talk about tomorrow. Based on a synthesis of macroeconomic indicators, bullion bank positioning,
futures rollovers, and market sentiment, the setup is clear. Early session. Expect a slight dip as short-term traders lock in gains from the previous rally. This is often amplified by algorithmic trading, creating the illusion of weakness. Midday, the market will likely stabilize as institutional buying begins, quietly absorbing selling pressure and shifting positions for the end-of-day move. Late session, a push upward is expected, with silver potentially climbing 0.8 to 1.2% intraday. This is driven not by sudden news, but by strategic rebalancing in futures contracts and ETF holdings. If you're trading or investing tomorrow, the key is to watch volume spikes and options open interest, because these are often the clearest indicators of insider positioning. Technical charts matter less than observing where the liquidity is flowing. This isn't guesswork. It's pattern recognition backed by history, market mechanics, and behavioral insight. The retail crowd will see the move after it happens, while prepared investors will already be positioned. Section 6. Final thoughts and call to action. Silver is more than a commodity. It's a reflection of human behavior, institutional strategy, and geopolitical tension. Predicting its price is not about reading charts or headlines. It's about understanding the invisible forces shaping every tick on the market. Tomorrow's move may seem small in isolation, but it's part of a much larger trend. Knowing the mechanics behind it gives you an edge, whether you're trading, investing, or simply watching. If you want to stay ahead of these moves, you need more than news. You need insight into how markets are actually controlled. Here's what you can do next. Follow institutional flows, not just headlines. Observe volume, futures, and options positioning closely. Always anticipate the market reaction before the public notices. Silver will continue to be a battlefield between ordinary investors and those who orchestrate price moves. The difference is in preparation. If you found this analysis valuable, hit the like button, subscribe for daily market insights, and turn on notifications so you never miss a prediction that could give you an edge.